5 tips for raising money for multifamily real estate investing. First, I would like to share with you the benefits of raising money. Most newbies who want to get their feet wet in real estate investing think that they need to have piles of cash to get started. Waiting until you save enough money is the wrong approach, and here is why. Go for more and better deals. Good multifamily deals in today's market are a dime a dozen. If you have funding from numerous investors, you have higher chances of closing bigger deals with higher returns. Now the bigger question is, how do you raise money from investors? Tip number 1, sample deal package. If you're a beginner investor, it's very unlikely that you have the credibility and credit that traditional funders and lenders are looking for. Even still, you can get investors financially committed if you have a good, solid, and created a nice sample deal package, which we call SDP. The SDP should include the following information: the location, the apartment unit mix, the photos, potential returns, project pro forma, actual financials, funding plan, management plan, repositioning plan and the upside, exit strategy, and the time frame. A good SDP gives you the selling and the talking points that you can share with potential investors and explain to them why they should invest with you. It also allows you to have more of a holistic view of your deal and as well gets you investors and make them financial commitment. Point number 2, get in touch with your existing connections, people that you have a relationship with. Finding a potential investors, it's not a walk in the park. This is the time to go and open your phone book, your phone, and everyone you know, people like your friends, your family, your colleagues. There's a good chance that those friends and family and colleagues might want to invest in your deals. And you know what? Even if they don't want to invest in your deal, they might know somebody that would be interested. When you're talking with your connections, make sure to highlight the selling points of the deal, including the expected returns. And the key is to try and make as many as one-on-one connections, one-on-one conversation with them. Tip number 3, you are the biggest risk. When you're eventually meeting one-on-one with your potential investors, you need to put your best foot forward. Remember, you're the biggest risk, and for a good reason. First, the investor may not know you as well. Secondly, they may not trust you just yet. Your first job is to build a rapport with the investors. Make sure that they are comfortable with you, as comfortable as possible. Show the investors that you have what it takes and you have the education and you are the right person for them to put faith in to give them the hard-earned money. Tip number 4, put your investment under a limited liability company. How you best structure the deal is boiled down to the complexity and the size of the deal. No matter how you look at it, always seek professional advice with the aim to have asset and liability protection. Seek advice from your CPA, accountant, or your attorney. Point number 5, how to raise money for your due diligence costs. You will need to spend some money on due diligence before you committed to the deal and before you raise money from investors. For example, you may need to have some funds to evaluate the financials of the property, or maybe to travel to the location. The best way to obtain those kind of funds may be from a low interest rate credit card, or maybe from a family friend, partner, or other investor you've done business with before. Conclusion: you don't have to have money to begin investing in multifamily real estate. You can use these 5 tips to raise money quickly and more effectively for your investment. But you do need to have a reasonable level of multifamily real estate investing education. See you soon, stay tuned, and make it happen.